We like for the doctors to focus on giving a great patient experience and making an exceptional environment in their clinic and treating the patients to the absolute best of their license. And then we will work on trying to drive more patients in, as well as trying to optimize the cost. And we spend all day thinking about that. Allow the doctor, in this case, to focus on what we believe he or she wants to focus on, offload the things that he or she doesn't want to spend as much time on. And at the end of the day, then we all benefit financially when it's time to transact the business.
Hello there, everybody, and welcome to another episode of the Orthopreneurs podcast. I'm your host, Dr. Glenn Krieger, and today, I know I always say this, that we got a special guest. Today, we've got a really special guest. He's a friend. He's technically, are you technically my boss?
No, you work for the PC, so
Yeah.
just adjacent. We're just friends.
He's el jefe de todos los jefes. He's the chief of all chiefs. Please put your hands together. Give a warm Orthopreneurs welcome to Jay Hedrick, CEO of Smile Doctors. Welcome, Jay.
Thanks, Glenn. Excited to be here and talk to you today.
It's truly my pleasure. And I want to start by just saying today's going to be an interesting conversation because people naturally assume when I bring on the CEO of Smile Doctors, it's like bringing on the CEO of Coca-Cola. We're going to sit and talk about Coca-Cola nonstop and how wonderful the original recipe is. That's not what today is going to be about. Yes, there will be some conversations related to specific OSO and DSO stuff. But my goal, folks, for bringing Jay on here today is because chances are you do not personally know a CEO of a multi-billion-dollar company. And am I wrong in saying, Jay, that right now the valuation of Smile Doctors is in the billions?
It is, yes. Yeah, absolutely.
So again, don't think of this as, it's just an ortho company. Folks, Smile Doctors' value is a multi-billion-dollar valuation, which means the person they select to run this is not just going to be your ordinary run-of-the-mill orthodontist who comes off the street. And so we'll get into Jay's background and everything else there. But what I hope you get out of this today are a few things. Number one, I want you to be able to have a conversation with a legitimate CEO of a significant company and learn about some business items that we're going to talk about. We're going to learn a lot about private equity and really what's the truth behind why things happen and what happens. We're not going to get into trade secrets. We're not going to get into anything specific related to protected information, but we're going to get into some really good broad conversations on this. And last but not least, whether you're in an OSO or DSO, whether you're considering an OSO DSO, or whether you can't even imagine it's in your future, we're going to get into some really good information relative to our space, specifically orthodontics, that will be helpful for you no matter what. And so as I ask everybody, Jay, we'll start with you in just a second. I just want to say one more thing. I'm sorry. I'm privileged and lucky enough to live literally 5 minutes from Jay. And we've had dinner together. We've become friends. It's more than me just interviewing some CEO I don't know. And so I am truly fortunate, Jay, to have you in my life, not just because of Smile Doctors, but because I really do value your opinion on so many things. And like I said, there's things Orthopreneurs or things remote response that I love to bounce off of you. And it's just beautiful to get your feedback because I value it so much. And I hope today people can see why I feel that way. And so let's start here. If you want to give everybody a short sort of, not a bio, but if I asked you, you're CEO of Smile Doctors, you weren't born in that position. How did you end up where you are?
Thanks again for having me on, and the feelings are mutual on the relationship, and love learning from you. Boy, how CEO of Smile Doctors. Listen, as I tell everybody, it's a mix of hard work and luck, being in the right place at the right time. But I started out as I was an industrial engineer from Georgia Tech. I wanted to go in and work to improve businesses. Instead, I went to work for a convenience store company chain called Racetrack. It was really big. And I was lucky there. I had a boss that told me, I can pay you an experience or money. It's better for both of us if I pay you an experience. I stayed there 9 years, and it was wonderful because he felt like if you could run, he'd give you the ball. And he wasn't big on titles or tenure. And so I got 20 years worth of experience in those 9 years. And so after that, I stayed in the convenience store space for a little bit of time, getting different experiences and higher levels of responsibility. And then I moved into the food space. And so I went in and ran a large chain. We had about 1,500 Pizza Huts and Wendy's. and did that for a while as the chief operator, and then moved into Payway as the CEO. And that was when I got my first CEO opportunity. And so that was a private equity backed business. So I've had a few runs in private equity. NPC was also private equity backed. And so I've done a little bit of both. I've had some companies that were owned by families, very successful families at Racetrack and Pilot Flying J, as well as some private equity backed businesses. And it's been a good mix. But we sold Payway, and I had an opportunity to look for a job for the first time, kind of openly. And I got really fortunate. I met Scott Law, Dana Fender, and Greg Goggins, the founders of
That is a
Smile Doctors.
solid trio right there, brother.
It is.
You're not leaving that room saying no to a job.
No, like, they just had such a passion for what they were doing and a reason to believe that I said, I actually went home and told my wife, I was like, this is like getting in on the ground floor at Chick-fil-A or Southwest Airlines or something that the mission and the foundational culture is set right. But hey, we need some work to make it realize its full potential, which is hopefully where I get to come in.
It's awesome. And the funny thing is, I think that I have a question for you after this, but I think people have a tendency to believe like, oh, there's all these OSOs and DSOs. Do you CEOs there's a lot of O in here, okay? Do the CEOs of the OSOs and DSOs,
it's a lot of O's.
Yeah, there are a lot of O's there. But do you know each other? Like, do you know the CEOs from a lot of the other companies that are out there?
Oh yeah, so some of them better, some just to say hi to at a conference. But generally speaking, it's a group of people that want the best for patients broadly and are trying to do the right thing for the providers in the industry. We have different tacks, we have different approaches, we have different philosophies, and sometimes different kind of ownership structures. So we all have our different lanes, but we do know each other, and we do end up. There's always industry events and other things where you end up getting together.
Yeah. Do you feel like people in your position in other companies and yourself as well, do you think it's something that you need to have? Do you learn how to do this? Are you kind of innately born to be able to take this? Because again, I'm going to go back to a story you told a little while ago about being paid in experience or being paid in money. The overwhelming majority of orthodontists, I would call very smart people, right? They're not idiots.
Yeah,
I've always said I'm the dumbest guy in the room when I go into a room of orthodontists. So you got a really bright group of people that I would tell you would not ever say to somebody, hey, I can pay you in experience or I can pay you in money. And more importantly, mean it from an experience. Like your story wasn't about money or experience. It was about the fact that whoever it was at Racetrack that told you that, they had a plan of how you were going to get paid back in experience, not just come work for me, but like you said, give you the ball and run with it. And a whole bunch of other things, I'm sure. Is that kind of individual who I've met numerous times is a different individual than we find typically in the orthodontist skill set. Is that person groomed that way from their graduate programs or the executive training programs they come up? Or is it they're born with a certain sense of sensibility and vision and being able to see things? And I'm referring to successful CEOs, not just, right? Or is it a combination of both? What's your thought on that?
Listen, I think it's a combination of both. I think there are immensely talented people that either wouldn't want to be a CEO for good reason or wouldn't be great at it. But I think there are also a lot of people that would be great at it that haven't had the experience and the opportunity and been put in the right place to get the opportunity. So I think it is a combination of, if you want to say, nature and nurture that makes it. The person who told me that, his dad had actually founded the business and he had been running it for 30 years. And so he had learned from the school of hard knocks, but he was innately a very smart guy. And he realized what would, so much of leadership, so much of business is understanding who you're talking to and what matters to them. Okay. And how you can deliver something of value to them that also creates value for the overall organization and for achieving the mission. And he was very quick and very smart to figure out what would resonate, what would get me, in this case, to stay and feel valued. It's interesting to make somebody feel valued while they're underpaid. And he did a great job of that. So
yeah, I mean, look, let's just say you did okay. It turned out all right.
It worked out, right? Yeah, it's a long game.
He gave you what he promised. And again, you just said it. It's a long game. It's having to think long term. And so I would suspect that if your son was presented with the same opportunity today, in today's day and age, by somebody who you trusted and said, I can pay you in money or pay you in experience, but it's going to be 9 years before you can get out and do your thing. You're 23 right now. You're going to be 32 before you really get out there. Would you tell them to take it, or would you think today that it's a different world?
Listen, I think you have two different things. One, there is a founder mentality, and there are a lot of people who say a failed startup is the same as an MBA. And I think that there's real value in that, right? Because you can learn a lot of things yourself. That said, I say you take the path that's going to maximize one, happiness, and two, earnings at the time when it really matters, which is in your 40s, in your 50s, in your 60s, when you've got a family, when you're providing for others. The time to experiment and the time to try things and take that risk and bet on yourself is in your 20s and early 30s, in my opinion. So if somebody offered that to my son, I would say take it if you're passionate about it, but don't take it if it's not something that you love and can see yourself doing.
You don't take it as a means to an end.
Yeah.
My daughter's 25. She lives in Manhattan. She joined a tech company straight out of college that offered her this amazing job. Week one, when she told me what was going on at the tech company, you have to resist the urge of being dad and saying, I don't feel good about this company taking everybody to Portugal. Why are you going to Portugal? Oh, they felt it would be a fun trip. I'm like, okay. And so ultimately, when the company failed, as guest, less than a year later, she's obviously distraught. And I gave her the same advice that Gary Vaynerchuk, if you know who Gary V is in New York City, we went to go visit him one day and we were talking, and he told my daughter, it's actually on his podcast. He said, look, you're going to live, that generation's going to live till the 90s, hundreds, to think that your career is going to be made or broken when you're 25 or 30 years old it's antiquated. When you retired at 60, you better make hay while the sun shines. But if we're planning on living till 85, 90, 95 or beyond, like that generation will, at the end of the day, like you're going to have multiple full careers in your lifetime. You might be a CEO of whatever for 30 years and then move on and become an artist for 30 years, right? It's a different world. And so I agree with you 100%. My question for you, my next one is, I think many people think that CEOs, like every caricature in every movie, you think of like Will Ferrell from like Barbie, the CEO of Mattel. He's sitting in a room surrounded by 8 guys and he's just rubber stamping things and screaming at people all day long. What is the really super glamorous day-to-day life of a CEO like? I had to throw that one in there because I knew that glamorous would get a good kick out of you.
You know what? There are parts about the job that are absolutely amazing and wonderful and are incredibly fulfilling. Glamour is probably not a word I would use to choose, but there are a lot of times where you get to see other people succeed. You see them reach their goals, reach the part of their journey that they want to, and it's incredibly fulfilling, right? To be able to have an impact on others' lives, as well as to, Scott Law says something. We're very fortunate to be able to do something that benefits our communities in a very favorable way and can benefit ourselves in a favorable way. And I feel that way about this role. But, on a day-to-day, it is a lot of meetings. It is a lot of decision-making. You can get some decision-making fatigue. But it's really about removing obstacles and trying to keep the North Star, and keep everybody focused on that. And then remove obstacles that are keeping others from reaching that, as well as kind of keep that framework and keep those guardrails in place when people start to veer outside of what's driving us towards our North Star. So it's, to me, it's really about empowering and supporting, building the right team, setting the right strategy, and then removing the obstacles and empowering them to go out and achieve the objectives that we need to.
Which sounds exactly like being the head of an ortho practice, just on a smaller scale, right? Create that North Star, your core values, which I talk a lot about. Who do you want to serve? Why do you want to serve them? Make sure everybody on the team is on board on that. And you're just mentoring people. And I'm being blunt when I say this. You're mentoring a different type of individual than the type of individual that most orthodontists are mentoring. In terms of where they are educationally, where they are intellectually, where their life goals are potentially. But nonetheless, you're just doing it for a lot more hours in the week than we are.
Yeah, and I'm fortunate enough, we're a large enough organization. I've been at large enough organizations where you've got some people that have time in their seat and tenure in what they've been doing. And so it's a different type of mentoring, and it's a lot of fun.
Hey everybody, tickets for Summit 2025 are on sale now. Take a listen to what some of the attendees from Summit 2024 had to say.
This is one of the most unique, most impactful meetings that you can go to as an orthodontist.
It has everything compared to other meetings: entertainment, the content in the meeting, the speakers, the food.
I learned a lot. It helps the practice, so it really kind of checks all the boxes.
You hope to get something out of it that is going to pay dividends for years to come.
Definitely return on your investment.
We take back a lot to our office.
You get information that you probably don't get easily at any other meeting.
Let's pivot a little bit if you can, because we talked about private equity. And one of the things I talk about when I discuss why people should or should not join an OSO or a DSO, one of the key characteristics for me, based on time value of money, was the equity, right? And the equity in private equity. Do you mind giving a quick definition of what private equity is to people, so that, again, you're aware of the fact that there's so many conversations around the OSO DSO space that I watch some of them and go, where did these people come up with this information? I was on a debate on another podcast of a friend of mine's, and the conversation was revolving, whereas I was just trying to give facts, but there was so much conjecture coming from the other side, so many subjective statements coming from the other side, that I'm just sitting there going, we don't have enough time for me even to start to spell these things. So I want to start with some definitions, if you don't mind, or explanations. Yeah. What is private equity, if you're going to explain it to somebody in an elevator on a tall building?
Yeah, listen, so to me, you've got two different big types of equity, right? You got public equity and private equity, and then you have full private companies. But private equity is generally one group of people who go out to other people and raise money. They create a fund. They then make an investment as the general partner in a business. Okay. And so unlike a public equity company that has a lot of shareholders, okay, that all have a proxy vote and are represented by a board of directors, in a private equity company, you primarily have one or two votes. Okay. You might have, in our case, you might have doctors, you might have management, you might have others that have equity, but the votes they're closely held votes. They're held privately, right, by the private equity sponsor. I'd say a big myth about private equity is that they want to reduce costs and slash and burn, and they're gonna
Gordon Gecko.
Yeah, absolutely. And to be fair, there are some of those out there. They are the minority because it's not a sustainable business plan. Right. And so people like the sponsors in Smile Doctors and many of the other sponsors out there, they're trying to grow the business. And the reason that private equity might be better than public equity in growing the business is that they don't have to report quarterly. And so they can take a longer term view of growth. And so public equity, man, if you miss your quarterly numbers, they're looking for layoffs or they're looking for changes, and they're actually more reactive. Whereas a private equity business can say, how do I maximize value over a 4, 5, 6, 7 year hold time to create a durable, sustainable business that someone else is going to want to buy and also believe there's another 4, 5, 6, 7 years of growth. And so they've got to continually do that, and they got to build a great foundation. And so to me, private equity really is, the successful private equity guys are growth investors. Okay. And they're trying to figure out how to create a unique, sustainable business.
Right. And I think you said it, but I'm just going to sort of dumb it down for lack of a better description. The most private equity that does pretty well for itself, I think the statistics I heard is that a top quartile private equity business typically turns between a 23 and a 42% annual rate of return. That's the top 25%. And folks out there who know the rule of 72, you don't need to be a genius to figure out if you're getting 23% on the low end of that, you're talking approximately 3 years to double your money. So is the reason why they're so successful, or the way it was explained to me, was that because they don't have to report quarterly, and because the money's given to them with the expectation of a set timeline. You can have this money, but I'm not going to pull it back out in a year or 2 or 3 because I'm not allowed. You're going to have this money for a 4 or 5 or 6 or 7 year time period. They have the ability to go do things when they're not looking over their shoulder, wondering about when their money is going to have to be liquid. Is that true?
No, that's true. And most of the LP commitments are actually 10 years, right? Because it takes them 2 to 3 years to deploy the capital, and then 5 to 7 years perhaps before they unwind it. So most of the time it's fairly long-term money, and so they don't have to knee jerk.
Just to interrupt for a second, I'm sorry, but that 10-year timeline is not the same as the timeline that it would take for typically for an equity event, which we'll get to in a minute. But I just wanted to put that on the shelf for right now.
Yeah, so that's the amount of time. If I had $100 and I went to a private equity firm and gave them my $100, I would expect to see my return sometime in the 7, 8, 9, 10-year range. If a private equity, their horizon for investing in businesses is tighter, but it takes them a period of time to diligence and find the company. So once they've got my $100, they can't spend it on day one. It might take them 3 years to figure out what they want to do to spend my $100 on. And then they need 5 years to create value. And then they go out and they sell that business and they return me my my $300.
Right. And to be clear, you as the investor, let's just say you're a teacher's pension fund, right? And you're given, $100 million to a private equity, whoever, TH Lee, let's use them as an example, a big private equity fund. You're giving them a huge amount of money, but they can jump in and out of company. You're expecting 10 years to get your money back potentially, but they're able to jump in and out of companies at a shorter timeline to create that value so that when your money comes back to you, the return is good. So for instance, in the history of Smile Doctors, if I'm not mistaken, it's the only American OSO to actually ever to have gone through any equity event, correct?
To the best, to the best of my knowledge, it is. It's just an OSO, absolutely. And we've been fortunate enough to do it a few times, right? We had Sheridan come in originally, and then Linden, and then most recently, THL came in and split with Linden. So yeah, we've been really fortunate, and that's not a track record that I believe anybody else has.
Can you explain then because I think this is misunderstood out there, when a TH Lee or Sheridan or whoever comes in and I'm going to use air quotes here and say buys. I hate the term, but when they buy the company or the asset, what exactly is going on, right? So Smile Doctors, let's just say, is owned by company X. We won't bring any names into this. And company Y wants to come in and buy. Why can't company X, I think I know the answer, but I want to hear it from you. Why does company X have to sell to company Y? It's a profitable company. It's doing well. Smile Doctors is company, whatever company we're talking about, is making money hand over fist. Why doesn't, we said earlier, Linden is one. Why doesn't Linden just want to hang on to Smile Doctors forever and ever and ever, the way we as orthodontists buy a practice and hold on to it for 20, 30, 40 years?
Yeah, because they're not necessarily buying these things for cash flow and dividends. They're buying them to get those huge returns for their shareholders, right? For their LPs. Right. And so the only way to do that is through a transaction. Now, I will say, especially in today's market, you're seeing that successful companies, the original sponsor is hanging on to a piece. So in our case, Linden hung on to half of it, but they wanted to return money to their LPs, limited partners. They also wanted to return money to the doctors that were partners. And so they needed liquidity to do that, but they also looked at it and said, but it's a great investment. We want to stay involved with it. So we're going to take half of our proceeds and roll them into the new company so that we stay invested and we get to continue to participate in the growth. So they do look at it and say, okay, we want to stay invested, but they want to create returns as well. And so it's a balancing act for them, right?
Right. And to that point, I'll be fully transparent here when I say, when that event occurred, we as doctors at Smile Doctors had the opportunity to put more money back into equity if we wanted to at that point. Right. And I will be fully transparent and say, me and my partner, Doug Shaw, we put 7 figures of our own money back into the equity because we believe that strongly in the future of the company. And again, for me, equity is a really, really big reason why anybody should join one of these companies, aside from the culture, which has to be a good fit, aside from the money you get paid up front, aside from being doctor driven. One of the reasons you should be joining is the equity, which people like Jay Hedrick and others are working on your behalf to grow that while you're just sitting in the chair doing ortho. And that to me is, you don't do anything to grow your equity other than try to run a profitable practice. Someone else is working really hard to try to grow my equity, correct? Would that be a fair assessment?
No, that's exactly right. And it grows, in a tax advantageous way. And so there are a lot of really positive things. But yes, we like for the doctors to focus on giving a great patient experience and making an exceptional environment in their clinic, right? And treating the patients to the absolute best of their license. And then we will work on trying to drive more patients in, as well as trying to optimize the cost and reduce, cost with the best providers, right? We don't want to go in and buy cheaper products. We want to get the very best products at the lowest cost we possibly can, which is a bit different, right? But we spend all day thinking about that, and it allows for a division of labor, which should provide the best patient experience, right? Allow the doctor, in this case, to focus on what we believe he or she wants to focus on, offload the things that he or she doesn't want to spend as much time on, right? And at the end of the day, if we all do our jobs, then we all benefit financially when it's time to transact the business.
Yeah, for sure. Now, things have changed a fair amount since we came on board in the OSO world. You've been CEO now of Smile Doctors 5.5 years.
Yeah, that's exactly right.
Yeah, so 5.5 years you've been there. You've seen some changes in the space. One of the biggest changes that I think I've seen, and you can let me know, I know Smile Doctors definitely made this change. I don't know where it fits in the rest of the OSO American landscape. And again, if you guys hear me putting qualifiers in here, OSO, DSO, American, North American, what have you, I'm trying to give, most of the people listening here are from the United States. And most of the people listening are orthodontists. And so when I talk about an OSO in the United States, I want to compare apples to apples. I don't want to compare anybody out there to, oh, but we're doing this in Canada, or we're doing this and we're a DSO. A DSO, do you want to take just 2 seconds real quickly, Jay, and explain to people, what is the, other than being made up of people other than orthodontists as well, what's a big difference between a DSO and an OSO, and why I'm separating the two out?
Well, I think the biggest thing is DSO would be the catch-all of everything, right? Whereas OSO is only orthodontic. So a DSO could have general dentists, it could have pediatric dentists, it could have oral surgeons, it could have endodontics, right? And so we have stayed very focused on just the specialty of orthodontics at Smile Doctors. There are a handful of other companies in the United States that are doing the same thing. There are a lot of businesses. DSO is a much larger subset, right? Of OSO. You could say you've got, fast food places, then you have the burger fast food places, and then you get to Wendy's, right? And so it's just a subset of the larger. So OSO is a subset of the DSO world.
So in American OSOs, I don't know if this is standard in the industry. I kind of know the answer, but I want to get it from you again. I've seen a big shift from Smile Doctors from going from 100% purchasing of assets to what you referred to, I think, is a JV model, joint venture model, where the doctor still owns a significant portion of their practice. And aside from the money they got at the beginning, aside from the equity they got at the beginning, they have an opportunity to grow that, keep the profits, right? A percentage of the profits, and sell that part back later on down the road. Is that, whenever I talk to doctors, I always say, gosh, if you had that when I joined, it would have been, I would have signed on day one. I wouldn't have made your life miserable trying to negotiate it.
No, not you, Glenn.
Yeah, sure. Sure. I'll pay you later. But the question I would ask you when it all comes down to it, is that something that a lot of other companies are doing, as far as you know? Is this something unique to Smile Doctors? And it's obvious that it's a win-win, because if you're giving people skin in the game, they're going to want to, right? This is something I would tell somebody. If you're thinking of joining a company, JV should be a no-brainer for you to be looking for if you're looking to join somebody. Would you agree with that?
Yeah, listen, I completely do. One, it's not, I don't think it is the standard in OSOs at this point in time. Okay. To the best of my knowledge, we're the only ones that are kind of really leaning into this, but there are DSOs out there that certainly do it. And some of those DSOs also partner with orthodontists, but as a pure play kind of OSO, I believe, but again, I could be wrong. I don't know everybody's structure. I believe we're the only ones doing it. But to me, it's so important to align everyone's incentives. And so you want everybody focused on the best possible outcome across the board. So we want them to have cash day one, right? Two, you want them to have equity in the top co, because that's really important, because you want them to share the best practices and share learnings and share their time with their peers, because a rising pond does lift all boats, right? And you want them to benefit from that. And then at the end, though, you want them to benefit from the growth in their own practice economics. And the reason why maybe less people do it, and one of the things is one, it makes decision making a little bit harder, right? You got to work through things because you have a partner now in every location. And two, you're buying a little bit less of the EBITDA. So if a practice, let's just say, makes $1 million a year, Okay. Historically, it costs a certain amount of money to support that practice.
Right.
If you're getting the whole $1 million and you're paying for the support, that's one thing. When you start doing a JV, perhaps you're only getting $700,000 of that value or $600,000 of that value, but the cost to support that practice doesn't actually go down, right? And so effectively, it's a more expensive thing. There are things that you do to try to kind of moderate that a little bit, but it's that is one of the challenges. But to me, having the alignment of incentives, having everybody pulling on the rope in the same direction is the most valuable thing we can have. And so that's why we are fully all in on the JV model.
Yeah, I love the idea of it because, again, when you buy 100% of someone's practice and they hit their growth incentives or whatever it is for the first or second year, there could be that tendency for them to go, good, right? Like, if I grow it, what's my value? Or why do I want to kill myself? And that's not what you want if you're looking to grow your equity in the broader corporation, right? And so two other things that I think I've seen in Smile Doctors, I know I've seen in Smile Doctors, and I'd love to get your feedback to know if this is something that, again, if it's happening broadly, so when people are out there looking, they can ask the right questions. That's the whole goal of this. There's two things. There's the bolt-on, right? And there's the de novo. The de novo, I can explain real quickly. It's the opportunity for us to open new practices with Smile Doctors as a partner. So if I want to have 2 locations, 3 locations, 4 locations, I can continue to do that with you as a partner because you get that percentage and we get that percentage, and we're partners again in growing it. The bolt-on, which is something I don't know if anybody else does. Can you explain what that is real quickly? Because I remember we used to call it the Aqua Novo. That
Seated
thankfully went
Novo,
away.
Aqua Novo, all sorts of crazy terms.
Yeah.
But, it's taking a practice that exists generally in the same or a contiguous geography of where you practice and almost doing the same thing. You buy it, but you're normally buying it. It's normally smaller than a practice we would look at to bring into someone like Smile Doctors. And we partner with a local doctor that has a vision to grow it. And we share the economics. We share the cost, right? So you split the cost coming in and you split the economics, but then you have the marketing and kind of the operations and the financial support of a large company with the local knowledge, the patient care, the patient experience, and the clinical excellence of a local doctor. And it's been a really powerful thing to take practices that were smaller, practices that were underperforming, and partner them with somebody on the ground that has a vested interest in growing them and seeing them serve their patients better. And it's really been very successful for us.
We're running low on time. I promised you I'd get you done at a certain time, and I'm going to ask you for 3 or 4 more minutes if you don't mind, just because.
Sounds good. Yeah.
I won't keep you long because there's so many more things I want to talk about, and I'm going to ask your permission for us to do this one more time somewhere down the road so we can talk about Smile Express, because I think that is important. Because what we're painting a picture here is the CEO's job is to figure out new ways to help make a company profitable, more valuable. Again, you went from a full 100% ownership to a JV model. You went from just do your earnouts to now, if you want to start de novos, if you want to add a bolt-on to it, right? And Smile Express is no different, but I don't want to give away the secret. The point is meeting patients where they want to be. And I would love to get into that in another conversation, because what's even more important for me to talk about in the time we have left is there is this feeling out there that and nobody better to dispel this myth for you. And when I say the myth, it applies not just to Smile Doctors, but to most OSOs and DSOs, which I think are good actors, not bad actors. We tend to think of that horrible DSO or that whatever it is out there, that people have this narrative where they think that the group, if you will, doesn't care about patients, doesn't care about the doctor. You're going to come in, buy my practice, and I'm not just referring to Smile Doctors. I'm referring to the industry, if you will. The CEOs that we talked about earlier that you know personally, who you see at industry events, there's so much bad mouthing out there that patients are going to get bad treatment, that doctors are going to be told what to do, that they're not going to be able to use the materials they want. And while I'm sure that's true in some groups, would you A, say that that's the exception, not the rule? And B, how do you as a CEO drive the culture in such a way to make sure that the doctors are happy and that the patient care doesn't drop?
Yeah, listen, I think it is the exception that people are trying to dumb down or cheapen the patient experience. I think the rule is that most of the CEOs, most of the OSOs, most of the DSOs that I know recognize that giving outstanding patient care is what makes the model sustainable. It's what allows us to have a business that's worth running or selling in the future. Okay. And if you erode that, then you don't have anything that's valuable. So most, I do think, really understand that. I think at Smile Doctors, we started with the saying that love people first, straighten teeth second. Okay. And we have continued to morph that to we are patient focused and doctor driven. And the way I look at decision making is kind of, you might have heard this, the three greens, right? It's got to be green for the patient. It's got to be good for the patient. It's got to be green for the doctor and the teams in the field. Okay. And it's got to be green for the stakeholders. Now, we will do things that are not green for the shareholders if they are the right thing for the patient. Okay. That's not one where we ever do that. But when we're looking at new initiatives or things to spend time on, we try to say, is it great for the patient? Is it great for the doctors and their teams? And is it great for the shareholders? And if we can find things that line up where are good for all three, then that's where we try to spend our time.
I'm going to ask you one last question and then let you go. Often when I have these conversations with doctors, and I'm telling everybody out there, if you have any questions related to OSOs, DSOs, I promise you, I will always give you 100% honesty, because the worst thing I could do is talk you into a decision that a year or two later you come back to me and say, Glenn, I listened to you and this is what happened. So if you have questions, come reach out to me. Confidential, we have a conversation, whatever's on your mind related to OSOs and DSOs, whether you're ready, thinking you might be ready, or down the road, let's talk. Just reach out to me on my messaging. But in my conversations, and I probably had 400 of these, maybe 500 conversations with doctors over the last 4 years, it's really interesting to me to see how many younger, not just younger, how many doctors chase the quote unquote equity multiple. Yeah. And they say, Glenn, I'm not going to join Smile Doctors. Smile Doctors has already had 2 recap events. I'm going to be the second orthodontist or the 5th orthodontist in this OSO that's just starting up. And they've told me I'm going to get like a 6 or a 7x multiple down the road. And you and I both know, and many do know, that the road is littered with the corpses of practices that chose that path. If someone's out there listening and says, I would never join a Smile Doctors because they've already had 2 recap events, what's the upside to me? Versus there's this really young, group and they want me to be the belle of the ball. I'm your son. No, I'm a decade older. I'm your son. By the way, people, it's a humbling experience when you're a decade older than the CEO of your company. I just want to say that out loud, okay? But I'm your son, and I tell you, Dad, I got 2 choices. I can either join the $3 billion company that's already been through 2 recaps, or I can join this young company that says my decisions are going to make a huge difference, and I'm going to shape the company, and I'm going to get like a 6 or a 7x multiple. What advice would you give me?
Listen, I think you've got to weigh the individual circumstances. Obviously, I don't think the value is capped at Smile Doctors, or I wouldn't be here, right? I think I think there's a lot of value in having a stable, successful business that has shown that it can weather the storms and continue to grow, right? And get the recaps. On the flip side, if it was my son, I would tell him, are you aligned with the other people? What is the probability? To me, it's always a risk-adjusted outcome, right? Somebody says you're going to. Yeah. So you take, so if it works, let's say you're going to get 6 times, but there's a what percentage chance of it working? 20%. Okay. Well, then is that really a 1.2 risk adjusted versus over here, you might get 2.5, but there's a 90% chance of that. Okay. Which one does better? But then follow your passion, right? Find somebody that you're culturally aligned with. We think a lot about culture. We have great doctors that say no to us, and we have great doctors that we decide it's not the right time or place or person to partner with, because for the doctors listening and for the companies, finding that right fit is the most important thing, and keeping that locker room great is the most important thing. So if it was my son, I'd say, don't do it for the money. Don't chase the money exclusively. The money is a big part of it, and you shouldn't ignore it, right? But figure out, one, what is the actual value you think you're going to get when you imply the likelihood of the outcome, okay? And then figure out, where do you think you're going to be the happiest? Where do you think you're going to enjoy going up? Who can support you the best? If you're in the small one, You're probably going to be carrying a lot more water, perhaps. If that's what you want, maybe that's great. Your ability to make an impact over a large number of things is probably going to be less likely, right? I mean, right now, if you were Dr. Casagrande and you're handling all of the Invisalign and everything for Smile Doctors, you have a really big platform. And you can make a lot of change in a lot of different ways. But it's really about what's important to you, Glenn. And I would tell everybody that everybody's circumstance is different, but don't chase it on the nominal value and believing, unless they're going to put it in writing and guarantee it. Okay, even if they have the best outcomes,
writing, right?
Yeah, even if they have the best intentions when they make it, you just have to weigh for yourself what the historical probability is of that happening, and then make your decision based on that.
Yeah, thank you, Dad. I appreciate the advice. But I will tell everybody, with the annual Smile Doctors meeting coming up in a few weeks, I don't know when this is going to air, but it's going to happen shortly. I'm going to be hanging out with a few hundred of my partners. And I can tell you all right now, I'm looking forward to going to this meeting to greet people who've become very close friends, people I respect, people way smarter than me on so many levels. And that's something I think anybody should be looking at, because at some point, the check you're going to get from any company is going to be within 10% of each other, right? You don't buy a $5,000 car for $7,000. Companies just don't do that. So when the novelty of the money in your account, and this is coming from firsthand people, when the novelty of the money in your account wears off and you realize that you're in a good place, are the people you're practicing with as partners the people you want to have as your partners? And if it is, then it becomes really fun. If it's not, you're in jail. And that is not a fun place to be. And so, Jay, thank you so much for making Smile Doctors a place that I'm thrilled to be a part of. Thank you for steering the ship on behalf of all of us who are partners in the company. And again, thank you for taking a beating that unfortunately people in your position often take, running a company that, again, so many know so little about, but have the loudest voices. And so thank you. And thank you for being here today. I really appreciate it.
No, Glenn, I feel very blessed to get to do what I do. And thank you for the time. And I've loved getting on here and love getting to talk to you. It's always a great time.
Till we meet again, talking about Smile Express.
Thanks.